Good evening and welcome to our MI class. Well, this is the first class of our MI refresher course. We'll be having a 1 month revision class with you until the 6th of December so that you'll be writing your exam well prepared on the 8th of December. And so we have about 1 month to prepare you for exam. I believe we have seen the material for today's class. Okay, so let me share my screen and let's get down to the material for today's class. Okay. Just a moment. Okay. So I believe you can see my material. Okay, now today's topic is relevant cost analysis. Relevant cost analysis. Before we begin, my name is Chima. That's Chima for short. The full name is Chimaroke. And you can find my number at the foot of the handouts. Yeah, you can see my number there. You can call me when you have issues with any topic that we've covered or anyone outside here that you want to get some clarification. Now let's look at the class rules before we begin. Okay, students are to be muted. Students should be muted at all times. So we will not want you to on your audio, or we will not want you to also on your video. This will distract the lecturer. So the lecturer will not know, will be distracted if he's seeing your picture or your face as he's lecturing. So let the only person that is showing is the lecturer. Okay, if you want to ask a question, you are not allowed to use voice. This audio is being recorded, and if you now have different voices coming in, it will distort the lecture. So if you have any question you want to ask, use the chat button. So use the chat button and type your question. As soon as you type it, I have activated the chat button here at my end. As soon as you type your question, I will see it immediately. So as you type them, I will see it and I will respond accordingly. So use the chat button. So also, if you have any technical difficulty, you can call the number here. Or one of the things I will advise is that you restart your device. Okay, like it was said in the WhatsApp group, restart your device so that the connection gets restarted. Okay, when you are asking your question, you be professional, use professional language. I personally do not like the use of too many shorthands. So just express yourself professionally. Don't use too many shorthands. Use them, but sparingly. Okay, let's listen attentively rather than writing. Of course, you could take some points down that is not in your notes, but if you pay more attention to the class, you will enjoy the class. All your questions will be attended to at the end of the lecture, or perhaps if it is relevant for me to attend to them immediately, I will do time. So let's go. Relevant cost analysis. What are relevant costs? What are relevant costs? Relevant costs is important in short-term decision making, such as limiting factor decisions, make or buy decisions, shut down decisions, anything that has to do with variable costs. You see relevant cost rearing its head out. Now, costs that are relevant to decision making are called marginal costs or variable costs. We use those two costs interchangeably because marginal cost is the cost of making one extra product of giving the available resources. And now, what do you call the extra cost of making one product? It's called the variable cost of that product. And so you see, marginal cost is variable cost. So we use them interchangeably. So today we're going to be looking at what are relevant costs. How can you identify which kind of costs are relevant? How will you know the relevant cost of material? And how will you know the relevant cost of labor? We're going to be looking at how we can price a contract given relevant costs. Okay, so now let's look at relevant cost versus non-relevant costs. Like we said before, relevant costs are important for decision making. Non-relevant costs cannot be used for making decision. Now, the following costs are relevant. We have variable costs. Now, why is variable cost a relevant cost? I will tell you. These are costs that are incurred when we have different level of activity. For example, if you decide to spend, if you are producing bread, for example, and it costs you 100 naira to make one loaf of bread. Okay, if you make 10 loaves of bread, it's 10 times 100 naira, which is 1,000. If you make 20 loaves of bread, your level of activity has increased. So it is increasing proportionally. So as it is increasing proportionally, you are making this cost. If you decide to produce nothing, you will spend nothing. And so two things that makes it relevant cost. One, it could be avoided if you do nothing. Two, as you increase your activity level, the cost also increases. So variable cost qualifies as a relevant cost. Now, what about the second one? Opportunity costs. What is opportunity cost? These are the cost of alternatives that are forgone. Let me give you an example. Okay, if you decide to pay for your ICANN exam, let's say you are paying for one paper and that paper is 32,000, and you decide that this money I'm using to pay for ICANN exam is what I would have used to go to, let's say, Obudukato Ranch to go and enjoy yourself as in vacation, or do one thing or the other, give yourself a treat, or maybe buy a new phone. Who knows? Okay, the opportunity cost of writing the ICANN exam is that forgone alternative. So you will see it a lot in relevant cost analysis. So the point here that makes it relevant is that you have alternative. Now, any cost that makes you have alternative is relevant because you can either choose one, and by choosing one, you have forgone the closest rival. So that closest rival that you would have chosen, if you have not chosen the one that you have chosen, That is the opportunity cost. So you have maybe 32,000 and you have arranged your list in order of priority. ICANN exam, number one, maybe Obudu Cattle Ranch, number two, maybe you want to buy a television, number three, you want to buy a phone, a small phone, number four, you arrange them in order of priority. And as you've done the ICANN, opportunity cost is the next alternative to ICANN, maybe Obudu Cattle Ranch. So because you have choice, opportunity costs are relevant. So you can decide. You see, the fact that you have choice makes you decide. If you have no choice, you cannot decide, you just do. So opportunity costs give rise to choices. All right, let's go to the third one. The third one is incremental cost. What are incremental costs? Now, these are costs that are increasing when there is an increased level of activity. So you see, it makes us think about variable costs, because when you increase your level of activity from 1 unit to 2 units to 10 units, you find out that the cost keeps increasing. Variable, that's how variable costs work. And so you see all variable costs are incremental costs. So you see another quality of variable costs, they are incremental in nature. That is their nature. But now, why are we not saying that incremental cost is a different kind of, is another way of analyzing relevant costs? Now, look at it this way. We know variable costs are all incremental, but there are some fixed costs that are incremental in nature. Now, let's look at one example of fixed costs. Okay, let's say our refresher course, which we are holding on Zoom right now. Okay, we have just one student here in MI, and the fixed cost of subscribing to Zoom, let's just say, for example, is 6,000 naira. And Zoom can seat 100 students. We have one student now who will incur that cost, 6,000 naira. Assuming that's an assumed figure. Now, if the students increase to 10, that cost is fixed. Students increase to 50, that cost is fixed. Increase to 99, increase to 100, we will still make that cost. Now, the moment we have 101, then we have options. So you now see options. One, increase the seat capacity. So that would mean that either we buy an add-on that will make us increase from 100 to maybe 300 seats or 500 or 1,000 seats, just because we want to accommodate the extra. Now that extra amount we are paying above the normal 6,000 fixed cost is the incremental cost. That additional cost incurred to take that one person is incremental cost. It normally happens with fixed cost. So because there is increment more than the capacity, we can now decide that, okay, let us increase the seat capacity. Or we could say, okay, no, let's have session A, session B of MI. That's another incremental cost. So we now, instead of using, maybe if it's a physical hall, instead of using the physical hall once and pay the normal fee, you are now paying ×2. Or maybe it's a lecturer you are paying. You are paying for 2 hours for one class, you will now have to pay 4 hours. That's incremental fixed cost. So anytime a fixed cost displays the incremental nature, now that's incremental cost. Okay, when we're looking at WhatsApp group, WhatsApp group has 257 capacity. Let's say we are paying for WhatsApp group to have a class in WhatsApp group, assuming we have MI1, MI2, MI3. So as soon as we migrate to MI2, MI3, we are incurring incremental costs. So that's it. All right, so we go to the next one, future costs. Now, any cost that you can make in the future, that is relevant. And so now it is not just that variable costs are relevant. It is not just that opportunity costs are relevant. It is not just that, what do they call this other costs? Incremental costs are relevant. The main thing that makes it relevant is the future nature of the cost. So any relevant cost must be made in the future. If a variable cost has been made in the past, it is not relevant. If an incremental cost has been made in the past, it is not relevant. If an opportunity cost you are talking about had occurred in the past, it is no more relevant. So relevant costs are future costs because that is what will help us to take decision. You can't take decision on a cost that has happened in the past. Rather, you will be planning to take decision on future costs. Okay? All right. So the next one is avoidable costs. Avoidable costs. Any cost that you can avoid is relevant. Why is it relevant? It's because you have options. It's either you implement or incur the cost or you avoid it. So you can take that option, avoid or implement. Future, that is relevant cost. All right. So you've seen that we've mentioned 5 relevant cost elements. And let me add it here too, that any cost that results in cash outflow is relevant. When we're talking about non-relevant costs, you get to understand this point. So we will say that a relevant cost is a future cost that is either incremental in nature. Okay, let me start again. A relevant cost is a future variable cost or fixed cost that is incremental in nature or an opportunity cost that could be avoided. Well, this is a clever play on words because I've used all the elements of a relevant cost to make that statement. So these are some of the learning tools you can use to help yourself to remember the qualities of a relevant cost. You could also say V, variable cost, O, opportunity cost, I, incremental cost, F, future costs, and A, avoidable costs. You can form a sentence. VOIFA, V-O-I-F-A, VOIFA is a relevant cost. All right. Now that we've talked about relevant costs, let's look at these costs that are non-relevant. Now we said fixed cost absorbed. That, of course, that's opposite of variable cost. So when you see fixed cost absorbed, they are irrelevant. Now, why are they irrelevant? Because, like I used the example of Zoom, we've incurred 6,000 naira. That's an assumed figure. We've incurred that amount for subscription, and so it has been absorbed and it is irrelevant. We will not be using it to take decision on how much we are going to charge students. We cannot use that to take decision on how much we are going to produce. Another thing here is sunk costs. Sunk costs are costs that are made in the past. So this is the opposite of future costs. So future costs, relevant. Sunk costs, costs made in the past, are not relevant. Now, how will you know a cost made in the past? Watch out for past tense. So if you see things like incurred, paid, these are written in the past tense. You just underline sunk. These costs are sunk. But when you see things written in the present tense, will pay, will be incurred, these are future. Now, these are future costs and you make them relevant. The next one is committed costs. What are committed costs? Committed costs are costs that are agreed upon in the past, but will be spent in the future. We say committed costs are not relevant costs. But you may be thinking, we say that committed costs will be made or spent in the future. How come they are not relevant? This is because the commitment, that is why it is called committed cost. The commitment had been agreed upon in the past. So it is irrelevant whether we are paying that commitment in the future. For example, you took a loan from your company. Let's say your company is paying you 100,000 and you took a loan of 500 or 600,000 naira to be paying 50,000 every month. Okay, that means for the 1 full year, you'll be deducting 50,000 from your salary. Now, if you want to plan your budget, say you want to pay your ICANN exam fee, and will you be thinking that one, you have 100,000? No, you'll be thinking that your salary is 50 because by commitment, 50,000 will be deducted from your salary. Yes, it's going to be done in the future, but that commitment makes it look like a sunk cost. So you don't plan with it. So you will now look at it. Okay, if I have to pay 32,000 naira from my salary, that will mean that I may have to look at 3 months or 2 months salary that will make me confidently pay this exam fee. So you're not looking at 100,000, you're looking at 50,000. Committed costs, you cannot touch them. It has been budgeted. And so it has been pledged. So they are not relevant. The next one is non-cash flow. Non-cash flow is the opposite of, will I say, okay, it's not the opposite, okay, but I will want to use it as opposite, so to speak, of incremental. We said incremental involve when a fixed cost changes in value. Yes, that's incremental. But look at non-cash flow. Non-cash flow does not involve the use of cash. So for example, you have depreciation or amortization. Now, when you make depreciation expense, we normally expense it in our profit and loss. We usually look at depreciation as an expense. But in the truth, no money has left your purse. The money did not leave your purse. Depreciation is just an accounting jargon to show that wear and tear and other factors have reduced the value of the assets. And so it does not involve the flow of cash. And so it is not relevant because no cash is flowing out. Okay, now the last one is unavoidable costs. We said that avoidable costs are relevant because we can make a choice whether to incur it or not. Unavoidable costs are not relevant because you cannot run away from it. You have to incur it. Let me give you an example. Okay. Let's say you have a choice to decide where to attend lecture. Okay. Now, these choices could be one, attending a weekend class near your house where you don't spend transport. Yes, it's a relevant cost because one, you can avoid it. Maybe you don't like the center or you are too familiar with the people there. You can avoid it. That's one. You can also accept. Another option available to you could be the Zoom class. You could accept that. You say, I don't want people around to know I'm in a class or I'm going to lectures. Let me do it in the privacy of my house. That's an option. It can be avoided. Oh, Zoom costs money, I have data and all that. It costs money. That data money is relevant. If you say you don't want to pay for data, you want to pay transport, that transport cost is relevant. It can be avoided. It's future costs. Okay, but now let's say you are planning also to include the amount of food, the money you spend for food. The money you spend for food is not relevant in the sense that whether you go to weekend class or you decide to come through Zoom or you decide not to learn at all, you cannot avoid eating. So whether you take the decision to learn or not, you cannot run away from the decision to eat. So you must spend that money. So that is irrelevant cost. So you cannot be using feeding as a relevant cost. Now that we've looked at relevant costs and we've compared them with non-relevant costs, we are going to look at how we can analyze relevant costs. We're going to be looking at how we can identify relevant cost of materials, direct materials, so to speak, and relevant cost of labor. Now let's look at it briefly. Relevant cost of material. In order to determine which material cost is relevant, we need to ask ourselves 3 questions. And as we ask ourselves these 3 questions, the answers to that questions could be yes or it could be no. What are these questions? Now, the first one is the material available in stock? Why is that question relevant? You want to do a project and you've just calculated that you need material. Not only that, you also calculate that you need, let's say, 1 kilogram of, or maybe 50 kg of flour to do bread. So the first question is, this 50 kg of material, is it available in the store or in stock? You have 2 questions to ask. So you see, choices, relevant cost. If your answer to that question is yes, that means you still have another question to ask yourself. That's why we say move to the next question. Now, assuming you answered no to that question, what does it mean? It means you don't have it in store. You have to go and purchase it. So what is the relevant cost here? Of course, is the purchase cost of the material. Which cost are you going to choose? Let's say you bought it before. Maybe you bought the 50 kg before at 35,000. So you see the words I use. You bought, past tense, before at 35,000. Now that's a sunk cost. You don't use sunk cost because it is not relevant. Historical cost is not relevant. The best question to ask yourself after identifying that you don't have it in stock is, how much will I buy it in the market if I go now to buy it? That means your current purchase cost of the materials is relevant. Now you've answered no, you've headed to the market, and you've bought the materials. Case closed. Let's assume you answered yes, the material is in the store. In fact, if I go to the store now, I will see the 50 kg material. Move to the next question. The materials that are available in store, are they in constant use by the company? Now, what does it mean? It means that this 50 kg material, if you don't use it, another person is going to use it. Another department is going to use it. In fact, the company is a constant thing. Maybe that's their main material they are using. So what does it mean? It means that you are using a stock that is being used by the company. Just give me a moment. Okay, I'm back now. So let me share my screen again. Let me share my screen. Okay, we can now see my screen, right? That's fine. Okay, so I was saying before that you have moved to the next question and you ask yourself, is the material in constant use? If your answer is yes, it means that as you take this 50 kg from the store, somebody will be waiting to use it, perhaps immediately. it means you must replace it. So the relevant cost here is the current replacement cost. Replacement cost is the same thing as the current purchase cost. It means that as you use it now, you are going to go to the market to buy it at the current market price and replace it. Maybe perhaps before they allow you to start using it, you've given them money to go to the market to go and buy it to replace, and that's fine. Now, the current the replacement cost and the purchase cost could be the same thing, but technically we call the first one when there is no material in the store. When there is no material in store, you don't say you are replacing, you are going to purchase when there is nothing in the store. But when there is something in the store and you are taking it, we use the word replace. So that's why you see it there, replacement cost. Now, if you answered no to that question, that means you are saying that this material that is available in store, it is not in constant use. That means you go to the next question. Okay? The last question there is, if the stock of materials are not in constant use by the company, does it mean that they are scarce in supply? You could have two answers, yes or no. If you say they are scarce in supply, you answer yes. That means it's a scarce commodity. There is likely an opportunity to use this same material for alternative purposes. So it means that, yes, because it's scarce, it's very, very precious. If I don't use it for this project, I can use it for that project. If I don't use it for bread, I can use it for cake, I can use it for shawarma, I can use it for anything. Opportunity cost is the relevant cost. Okay? But if you answered no, it means that one, you are saying it is not scarce. It is so available that anywhere you go, you can just see it. The relevant cost is zero. Why is it zero? One, it is in store. It is not in constant use. It means if you use it for this project, you're not likely to replace it. And you don't have any alternative to do. So since you don't have any alternative, the opportunity cost is zero. When there is no alternative or opportunity cost, the relevant cost is zero. But now let's say that you say that, okay, you have no use for it. But if you don't use it for this project, you have to dispose it. So if you have to dispose it, it means that the cost of disposing the material is the opportunity cost. Let's say it's a material that normally costs 50,000 naira in the market. Okay, but you are not going to the market to go and buy it to replace it. So you cannot say current market price is the opportunity cost because you won't buy it. But you think about it that if I don't use it, it gets spoiled. I'm going to call people to come and throw it away, and I will pay them money for disposal. That money you're going to pay them is the opportunity cost. Of course, let's say you say, okay, instead of paying to dispose it, I could even sell it for scrap. If I don't use it for this project, I can just sell it at a giveaway price, scrap value. So that cost of disposal, that scrap value is the opportunity cost. All right, there's a diagrammatic way of looking at it. So this is the diagram to show the relevant costs. The relevant cost here, the yes or no question have been put nicely in a diagram so that you can better appreciate it. Now let's look at a question here to illustrate our point. The question here is, Grace Chika Limited has been asked to quote a price for a one-off contract. Underline the word one-off contract. These are the kind of things that requires relevant cost decision. One-off contract. What is a one-off contract? A one-off contract is a contract that you may not likely do again. Even if you do it again, it comes maybe once in a blue moon. And it means that you are going out of your ordinary thing that you are doing to do that contract. It means that you are likely to charge lower than you would actually charge for your ordinary normal job because it's a contract. And this is because you are doing it in large quantity. One-off contracts. The contract will require 5,000 kilograms of material K. So since you have seen that material is mentioned here and this is the requirement of the material, you start asking yourself the 3 questions. What are the 3 questions? Is the material available in store? Is the material in constant use? Let's see. Here we are told the material is used regularly, so it is in constant use. What question is that? That is question number 2. How do you jump to question number 2? It is because you said the material is available in store. That means you must have answered question number 1 as yes for you to move to question number 2. Okay. The company has 4,000 kilograms of material K currently in inventory. We'll talk about this, which costs 400,000 naira per kilogram. The price for material K has since risen to 420 naira per kilogram. Before we go to the second paragraph, let's deal with the first paragraph. Okay, let's look at the solution. Oh, sorry. Let's look at the solution here. Hold on a moment. Okay. Now look at the solution now. Look at material K. We'll ask the 3 questions. Is the material, okay, before we ask that question, we require 5,000 kg of material, right? Material K. We ask the question, we amend it. Is the 5,000 kg required materials available in store? We can answer yes, we can answer no. In this question, in this particular instance, we will answer yes and no. The contract needs 5,000 kg. We can say yes, we have 4,000 in stock. No, we have 1,000 not in stock. So how do we deal? We have to deal with them in 2 ways. So we splitted it. The one who answered yes, we'll handle it different. The one who answered no, we handle it different. When we say yes, the material is available in store, 4,000, we will move to the next question to handle the 4,000. When we say 1,000, we said no, 1,000 is not available in store. It means we are going to the market to go and buy 1,000 kg of material because what we have is 4,000 and we need 5,000. So 1,000 kg is not available. So we shall make a fresh purchase of 1,000 kg. How much are we going to buy it? The question says here that the company, okay, the price for material, okay, the company has 4,000 kg of material K in inventory, which cost 4,400 naira per kilogram. It means as at when they bought this 4,000 kg, they bought it at 400 naira. And that's a past cost. They say the price has risen to 420. It means if you go to the market now, you will buy it for 420. And so the relevant cost is 420 naira per kg, the current purchase price. 400 naira is not relevant. So the 1,000 kg, if you go to here, the 1,000 kg at 420 naira will give you 420,000 naira. Now that is how we handle the 1,000. Let's get to the second question. The second question has to do with 4,000 kg that we said is available in store. We will ask, the 4,000 kg that is in stock, are they in constant use by the company? Now let's look at it here. The paragraph says, material K is used regularly. That's the key word. So they said the material is used regularly. What does it imply? It implies that this 4,000 kg that you see in store, lying there in the store, 4,000 kg, yes, lying in the store. Since it is used regularly, as you are using it to do this your contract, you have to replace it. Take note, 1,000 kg is not being replaced. It's a fresh purchase. 4,000 kg is being replaced. At how much? At the 420 naira replacement cost. So you look at it here, replacement of 4,000 kg at 420, additional purchase of 1,000 at 420. Everything will give you 2,100,000. So you see, you will be buying the whole 5,000 kg that you require. You will be buying the whole 5,000 kg. And you will be buying them at 420 naira. But we'll split it for the sake of analyzing the relevant costs. The 5,000 you are buying, you are using 4,000 out of it to replace what you are seeing here in the store. So it means that as you started using it, you sent someone to go and buy another 4,000 to replace it. Of course, you give the person money to buy 5,000. As he's buying the 5,000, he's taking 4,000 back to the store to replace. He's taking 1,000 to you as fresh purchase to continue your contract. So that's relevant cost of material K. The question continues. The contract would also require 2,000 kilograms of material Q. So we ask ourselves these questions. Look at, is the 2,000 kg required materials available in stock? Let's look at the paragraph. They said there are 1,500 kilograms of material Q in inventory. Now let's stop so far. It says there are 1,500 kg available in stock. We are saying yes to that. That means we are going to move to the next question with regards to 1,500. And that implies that there are 500 kg not available. What does that mean? Additional fresh purchase. So the thing we'll be looking at is how much is the current market price? Let's look at the question again. We'll jump and come here and say new purchases of material would cost 100 naira. So that means if you want to buy any new material per kilogram, be prepared to spend 100 naira. That's a future cost. current market price. That's 100 naira. So what you're going to do now is you will say 100 naira per kg multiplied by 500 kg. That is your additional purchase. What do you do to the 1,500? You ask the next question. The question is, the 1,500 kg that are in stock, are they in constant use by the company? Let's see what the paragraph says about it. We'll start from the second sentence. There are 1,500 kilograms of material Q in inventory, but because of a decision taken several weeks ago, material Q is no longer in regular use by the company. So it means that this material is not in constant use. Prior to this time, we would have been using the material regularly, but management have taken the decision, stop using material Q for production. And so it's not in regular use. So you've answered no. And because you've answered no, you cannot go to the, you have to go to the third question. You have to go to the third question. Because if it is in regular use by the company, all you need to do is, if you use it, you replace. But now it is not in regular use. That question here is the stock of 1,500 kg of material Sorry for my network. Someone just called my number and threw me off. Sorry. Let me share my screen again. All right. If the stock of 1,500 kg material are not in use by the company, does it mean that this material Q is scarce in supply? Okay, the answer is no. The material is not scarce in supply, but the company stopped using it as a matter of policy. However, there seems to be an alternative. Okay, the 1,500 kg originally costs how much? 144,000 naira. When you hear originally cost, it means it's sunk cost, historical cost. This cost is not relevant. Now, they say they have a scrap value of 36,000. Now, scrap value is future cost, because if you don't use it in this material, you have a choice of selling it off for 36,000 naira. So how will you value the 1,500 naira, 1,500 kg? Now look at it. 1,500 kg of material was bought initially at 144,000. You cannot value it at 144 because that's a past cost. You cannot go and replace it because you are not replacing it when you use it. So this 100 naira times 1,500 is not relevant. So you cannot say 150,000 naira. It is not relevant because you are not replacing it. So what you look at is what is the future cost to be incurred, or what is the future value you will get from this material. The future value you will get from this material is the scrap that you gain when you sell it. So it's either you use it for this project or you sell it. So it means the value of your material is the scrap, 36,000. So that's it. So what you will now do is, the question says, identify the relevant cost of material to assist management get a minimum price to charge for the contract. So you see, the minimum price to charge for the contract is you make additional purchase of 100 naira for each, for the 500 kg that you are going to buy in the market. Then for the remaining 15 kg, you use the opportunity cost of disposing it, which is the scrap value, 36,000. When you add them together for material Q alone, your relevant cost is 86,000. So when you bring total material cost, that of K is 2,100,000, that of Q is 86,000. Add them together, you have 2,186,000. That is your relevant cost of material. I believe this is clear. We'll now move to relevant cost of labor. Now, another variable cost is labor cost. So material is a variable cost, labor is a variable item. Now, in order to determine labor costs that are variable, we need to ask 3 yes or no questions, just like we did for material. Now, what are these questions? Question number 1, the labor that is available, is it in permanent employment? Because they will tell you, you will need labor for this job. This is the number of hours that is required to do the job. You ask yourself, do I currently have this labor available in permanent employment? Your answer could be yes, your answer could be no. If your answer is yes, it means that you already have people working for you permanently. And it means that all the time they come to work, you have bought their time and you've paid for their time. So when you answer yes to that question, you move to the next question. But if you answer no, it means you don't have the labor. That means to do this contract, you need to get contract staff because you don't have permanent staff to do it. You need to go and get a contract staff. After the contract, you lay them off. So what will you do? You pay them per hour. The hourly pay is relevant. Or you want to pay them in piecemeal. The next question says, the permanent labor that is available, do they have spare capacity? What is spare capacity? It means that at their time that they are idle, doing nothing, that means they sit down, they are doing nothing. Maybe there is machine downtime, it's idle time, they are just sitting down, waiting for work to come. Do you have times like that? Then you will not see them maybe be gisting, be playing, because when you ask them, what are you doing? Why are you doing nothing? They say, there is no work. Do you have such time? If you have such time, that means you have answered yes. And you have a contract that you need job, you move them. All right, you are doing nothing, please, please, please come and do this contract. You can't be sitting down doing nothing. And so what is going to be the relevant cost? Are you going to pay them? You're not going to pay them specially for this contract. Why? Because you have already paid for the time and they are not supposed to be idle. So each time they have idle time, it means they have spare capacity. They can spare some time for the contract. So spare capacity is nil relevant cost. Each time you see spare capacity, two things should come to your mind. One, spare capacity belongs to permanent laborers. Two, spare capacity is zero relevant cost. These are the two things that should come to your mind whenever you hear spare capacity. Now, let's say you answered no. It means your permanent laborers do not have spare capacity. It means they are never idle at work. It means that when they come to work 9 to 5, they are working at that time. Perhaps the only time you see them not working is when they leave for their break. So you cannot count break as idle time. No, they need break. Maybe that 1 hour, 30 minutes, they need it. But apart from break time, they are not idle. There is no spare capacity. You move to the next question. The next question is, since there is no spare capacity, is it possible that they can do the contract using their overtime? Is overtime possible? If you answer yes, that overtime is possible, then you have to pay them overtime rate. Now, how is overtime possible? Overtime could be possible. Maybe you ask them that, okay, you're always having no spare capacity. Yes, I know that your job is from 9 to 5. Can you come a little early, let's say 7 o'clock? And when you work from 7 till 9, it's just a contract, I have deadline. So from 7 to 9, I'm going to pay you overtime rates. Is it possible that, okay, you close 5 o'clock, there's going to be hold up in the road? Why not stay again for another 2 hours till 7 o'clock and do this project? So maybe you've done 2 hours before work, 2 hours after work, that's 4 hours overtime, and you are being paid overtime. That's one way of overtime. Another way is that, okay, because the job is still pressing, normally you don't come to work on weekends. Please come to work on weekend. I'm going to pay you overtime for weekend. That's another way overtime is possible. So it is possible that you can have overtime. You answered yes. What if it is not possible for overtime to occur? That means you ask the person, can you come to work by 7 o'clock? No, my place is very far. As even 7 o'clock, I leave home. There is no way I can leave my house 5 o'clock and come to, no, I can't. Okay, can you stay back 2 hours after? No, I have children at home. I can't be going home by 10. No, I have to be there latest 8. If I leave 5 o'clock, I'll reach my house like 7, 8. No, I can't stay. Okay, can you come on Saturday? No, I have exams to write. I'm writing exams. That's the only time I also have to read. Overtime is not possible. There are some people like that. Overtime is not possible. Okay, the boss looks at everything. Overtime is not possible. What do we do? the boss will say, okay, stop what you are doing now. Let's say you are working 9 to 5. By 12 o'clock, stop what you are doing between the hours of 12 to 4 hours. I want you to spend that time on the project. Oh, sir, if I stop, we're going to lose money. We're going to lose contribution. Yes, I know we're going to lose contribution. That contribution we are going to lose is an opportunity cost for doing the contract at that time. So you do the contract at that time, you spend 4 hours. How much contribution will you lose for not doing your normal job for 4 hours? That's the opportunity cost. That is relevant. That opportunity cost you are going to lose is relevant. So we've seen the relevant cost of labor, and it is nicely done for us in this beautiful chart. Relevant cost of labor, similar to that of material. So now let's look at one question and let's see how we can use the above points to illustrate it. Augusta Chinenye Limited has been asked to quote a price for a one-off contract. Once again, we are saying one-off contracts. The contract will be done in their 3 departments, known as Department 1, Department 2, and Department 3. So that means this contract is their usual job that they are doing, but they are just doing a one-off contract for a customer. And so they're going to be using some of the things that they are using in their normal, regular job to do the job. They said Department 1. Now that contract would require 200 hours of work in Department 1. So what's the question? The first question is let me get to the answer. The first question is, is the labor available, and is it permanent? Is the labor available in permanent employment? Let's look whether they are available in permanent employment. They said 200 hours of work in Department 1, where the workforce is paid 116 naira per hour for a fixed 40-hour week. Now, what does it tell you when you see something like this? Fixed 40-hour week. The word fixed, either 40-hour week or anything you see here, that fixed means they are paying you for a fixed amount of time, whether you work or not. Another way you can see it is guaranteed 40-hour week. Now, these two language, fixed 40-hour week, guaranteed 40-hour week, is the language used for permanent employment. There is no way you can be paying a temporary employee a fixed amount of money. It's only permanent employment these apply. So that tells you that Department 1 workers are available in permanent employment. So the next question to ask, because we said when we answered yes, the next thing is to move to the next question. The permanent employee or permanent labor, do they have spare capacity? So let's read on. There is currently spare labor capacity in Department 1. What does that tell you? There is spare capacity. And what do we say about spare capacity? If we say yes, it means they have idle time. They have already paid them for their time. So that means if they do the contract with their idle spare capacity, the relevant cost is nil. So relevant cost is new here in department 1. So this 160 here is not relevant because they are in permanent employment, having spare capacity. So when we see that, we said new. Let's get to department 2. In department 2, the contract will require 100 hours of work in department 2. So we'll go back and reset and start reading the question again. The labor that is available, that's 100 hours that is available. The workers that will do that for 100 hours, are they in permanent employment? Let's see. They said the contract would require 100 hours of work in department 2, where the workforce is paid 240 naira per hour. They're just informing you. This department is currently working at full capacity. Now, what does it tell you? Each time you see capacity, whether they say spare capacity or no capacity or half capacity or full capacity, the word capacity belongs to permanent employment. You cannot use capacity for temporary workers because they come and they work. If they don't work, you don't pay them. There's no capacity for them. Work as you can and get paid as you can. But for permanent labor, your capacity is work from 9 to 5. We've already paid you. And we are saying here that they are working at full capacity currently. It means no time to spare for the job. There is no spare capacity. And what do we say about that? When there is no spare capacity, we move to the next question. The next question is overtime possible? Let's read on. The workforce could be asked, the company could ask the workforce to do overtime. So overtime is possible. That means the overtime rate is possible. Paid at the normal rate per hour. What is the normal rate? 240 naira is the normal rate plus 50% overtime premium. So you add 50% of 240, that is 120. 120 plus 240 is 360 naira. So you're going to say 360 naira multiplied by 100. I think that's going to be 36,000. That is what you are prepared to spend over time. So you're going to pay the normal work and you're going to do overtime. Alternatively, now when we say alternatively, it means there's a choice. It's either I ask you guys to do overtime, or if overtime is not possible, there is another choice. Choice is relevant. The workforce could be diverted from other work that earns a contribution of 80 naira per hour. Now, what does it mean? It means that as I divert you from the job that you are currently doing, which you are working at full capacity to come and do this job, it's as good as I am hiring you as a temporary staff. I'm going to be paying you now 240 naira per hour for this job. Yes, I have paid you for your time, oh yes, but I'm diverting you from your job to come and do this. So I must pay you for this. Because if I don't want to pay you, go and get temporary staff now, and you are going to pay them. So now I am converting you to temporary staff to come and do this. I'll pay you 240. Then, by stopping your job, you are losing 80 naira per hour. That 80 naira per hour, I'm going to add it to whatever I'm going to be spending on you. So what will happen is 80 naira plus 240 that gives you 320. 320 times 100 hours will give you 32,000. So you're going to compare. The company could either spend 36,000 asking you to do overtime, or they could spend 32,000 diverting you to do the job and losing 80 naira contribution. Which one will be cheaper for the company? The company will rather want to do the 32,000. So 32,000 will become the relevant cost. So let's look at the answer here. You see, the first one has a nil capacity. The second one has overtime of 36, alternative 1, and 32,000, alternative 2. So they will choose the second alternative, which is cheaper. And so they would divert people from their work, come and do this. Let's go to Department 3. They say the contract will require 300 hours of work in Department 3, where the workforce is being paid 240 as before. Fine. You ask yourself the first question. Is the employee in permanent employment? Labor in this department is in short supply. What does it mean? It means the laborers are in permanent employment, but they are in short supply. And what does that mean? Since they're in short supply, there is possibly no idle time. Possibly no idle time. And they say, and all the available time is currently spent. So no idle time, making product Z, which earns a contribution of, look at the contribution. It means sales is 980, labor and other variable costs. Contribution here is 200 naira. What is the significance of these 2 hours here? It means 2 hours is being spent in making 1 unit. What does it mean? It means 1 unit earns a contribution of 200 naira, or 2 hours is being spent contributing 200 naira. Now that's significant. If you want to tell them to come and do 300 hours of work, and you don't want to go and hire employees outside, you are telling them that if they stop the production of product Z, which they spend 2 hours in making 1 product, how many products are they going to stop doing? It means they are going to stop 300 hours divided by 2 will give you 150 units. It means 150 units will be stopped. Now, what is 150 units? 150 units is earning 200 naira each. So 200 naira for 1 unit multiplied by 150 hours, or 150 units rather, that gives you 30,000 naira. That's one. Another way of looking at it is this. We require 300 hours, right? Fine. And we are taking 2 hours each. 2 hours each. That means if we spend 2 hours each, it means we are going to use the whole 300 hours, right? Okay. We are going to use the whole 300 hours, 150 units. Okay, let's go with the 150 units scenario I gave to you. So 150 units will be lost, and 200 naira for 1 unit multiplied by 150. So that's the relevant cost. So let's look at the solution, the third solution. They said the department is in short supply. So what happened here is this 300 hours that is being lost. What happened is they are going to pay them the normal 240 because you are diverting them to come and do that job. 300 hours that you need, you pay them the 240. Now that 150 units that you lost, that 150 units that you lost, the lost contribution is 200 naira each, giving you 30,000. You add this 30,000 to the normal 720 and you get 102,000. That's the relevant cost for the third department. That's the relevant cost. Okay, so what is the total relevant cost for labor? Total relevant cost of labor, Department 1, we say it was 0 because they have spare capacity. Department 2, we had two options, overtime of 36,000, diverting of work, we spent 32,000. We say 32,000 was the cheapest. In Department 3, they don't want to hire a temporary staff. This is a lost contribution plus the normal job, 102,000. Add them up together, you have 134,000. Now that's the labor charge. This is just the labor charge. Now, assuming we are our example 1 and example 2, we are fused together. Assuming they are fused together, and they said, give us an overall amount to charge. You have to do for material relevant cost, material K, material Q, you join them together, look for labor, Department 1, Department 2, Department 3, you add everything together and you say material relevant cost, this amount, labor relevant cost, this amount. You join them together and you want to quote a price. Your total relevant cost of material and labor joined together is the smallest relevant cost. That is the smallest contract price you can give. Now let's assume that, okay, let's even go to the relevant cost of material. Let me see the amount. Okay, relevant cost of material here gave you 2,186,000. Okay, relevant cost of labor gave you 134,000. If you are to add them together, it gives you 2,320,000. Now that is the minimum price you can price for the contract. You cannot price below that. That is one of the reasons for doing relevant cost, to know how much least cost, least price you can price your contracts. So you can price, okay, give me 2.5, you'll be making profit. Give me 3 million, you'll be making profit. Assuming you've priced the person 3 million, and this person says, no, this is too much, I can only give you 2.5 million. You know you are making a profit or contribution, not even profit, you're making a contribution because your relevant cost is 2,320,000. Anything above that will increase your profit. So you've made a contribution. But if you say, okay, I will give you 2.32 million, it means you are making no profit. You are making zero contribution. Zero contribution. That is like a break even. You are like a break even, no contribution. Now, so far, so good. We've done relevant costs. We've looked at relevant costs. We've seen some that are relevant, some that are non-relevant, how you can know them. We've looked at relevant cost of material. We've answered 3 questions to analyze them. Relevant cost of labor, 3 questions to analyze them. At this point, I would like to see if you have any question. If you have any question, you can go to the WhatsApp group and drop your question. Maybe you don't have question at the moment. You can chat me privately and ask your question. Maybe when you're looking through it again, you may have some questions. Feel free to look at material and feel free to solve past questions that highlight this point. So at this point, I want to say thank you for coming to the class. I believe our first class today was a wonderful class for you. So thank you so much and good night. Prepare for the next class if you have the next class, or have a good night rest. Thank you so much, kindness.